Lovely. Okay. So welcome everyone to our January CBAM webinar. We've got Mark and Sam with us today to present the portfolio performance review and outlook. We are aiming for about 45 minutes to an hour, including some questions at the end, which the guys will be happy to answer for you. So if you just pop any questions you do have, just down in that little question and answer box to the right-hand side, we can get to those at the end. And as usual as well, we will be recording this and that'll be sent out to you guys or anyone who signed up for the webinar later on today. So guys, I will let you take it away.
Sure. Hi there all. Firstly, happy New Year. I hope you had a good festive period. On to our Q4 performance review. Today's presentation will, as usual in these sessions, have a look back at what happened in Q4. Hopefully, obviously, lots of people versed from the performance reports and asset summaries and stuff that's already gone out. But yeah, this is our chances. Cape Berkshire Asset Management to sort of dive into that a little bit more and also try to give a forward-looking view of what we think is coming in the coming year. We'll reflect on some positives and negatives from the prior year, and then in today's presentation we just want to add some added clarity to sort of just an internal merging of portfolios and things. So there's a few slides on that as well that I will take and I can answer any questions and things. But with me is Sam, who many of you guys obviously already know. Sam, I'll hand over to you for the review of Q4.
Good morning, everyone. I hope you're well. Just some important T's and C's to just quickly clear off as per normal. This presentation is for information purposes only and does not constitute any financial, legal, or accounting advice. Cape Berkshire Asset Management is a trading name of Cape Berkshire with our FCA registration number there. And Cape Berkshire is an appointed representative of Ascot Wealth Management with said FCA number. And obviously, as we are an appointed representative of Ascot Wealth Management, Cape Berkshire is also authorised and regulated by the FCA. These investments are not suitable for everyone, although, of course, that's a large part of why you have financial planning is to make sure that you are allocated into appropriate investments. Cape Berkshire portfolios do charge an annual management charge, which we will lead on to actually later. It's very relevant this time around. Tax legislation could change in the future, but that's more relevant from a wealth management perspective than a portfolio perspective. And of course, investments can go down as well as up. However, of course, we certainly aim to be heading upwards. So there's just a listing of exactly what Mark just spoke of there. But let's go straight on to talking about how what influenced the last quarter in the market. So I think one thing that was a very important thing was government interest rates. It was very much a roller coaster, finished very much to the positive side of things, but it certainly caused a little bit of panicking to a degree in October. Panicking is perhaps the wrong word, but certainly contributed largely to bad performance in October. What we had there was the 10-year government interest rates, particularly, say, for example, in the US, rose up around about 1% up to around about 5%, and that really kind of affected not just the bond components of the portfolio, but also the equity components as well. So it was really difficult in October to find positive performance. Completely opposite picture going on in November and December, which was fantastic. One thing that we did execute well was that switch from being a bit more defensive from the Q3 to more aggressive in Q4. So we helped capture that benefiting environment, which we'll lead on to in a second. Q4 earnings were generally very supportive, not big surprises either way. So that's one thing that we tend to quite like is when things don't surprise you too much. But companies are earning good money. It's corporates balance sheets are very different perhaps from personal ones, with how consumer inflation has been, and everyone's been, cost of living, etc., to use a very well-coined term over the last couple of years. Corporate earnings have been very well supported, so that's helped very much with equity markets over the last couple of years. Finally, China there, which will lead on to a little bit in a couple of slides down as well, but it's quite important in the context of the portfolio. Do you want to handle these two, or did you want me to carry on?
You can carry on.
Okay, I get to carry on the good news. So looking at, over the course of there, we see that the portfolios rose by over 4%. Some places up close to 6% on CBAM 2v2 rose 5.8%. The lowest performing was CBAM 3v1, up 4.35% over the quarter. So all portfolios are up quite healthily, which is obviously a very nice position to be in. One thing I have included on this graph, because it was one thing that was quite dominating a lot of conversations on the financial planning side, end of quarter three, so September, going into October, was about cash returns relative to the more investment side of the portfolio. Here I've included a very good proxy for that, which is the Royal London Short-Term Money Market Fund in red. And as you can see, over the quarter, outperformed that by quite a long way, around somewhere between 3 to 4.5%, depending on the portfolio. So very good from that perspective. Just looking at the year as a whole, obviously very important. We see performance anywhere between 5.04% up to 8.63%. So again, although it was a very bumpy year, very volatile year, it ended up being, as a whole, a well-returning year, one that we see reason to continue. Same narrative, actually bumpy, but leaning upwards throughout 2024, which is positive. Just seeing there again, all portfolios outperformed cash in what was cash's best returning year for over 15 years. So just showing that, patience with portfolios is often very important. But it's important. We, of course, utilize it within the portfolios. It's a very important tool to use to help dampen volatility when we see we might be entering a period of higher volatility. Good performance, I think, there. Just looking at the top and bottom performers there for the quarter, I think we'll pick a couple there. So looking at the Allianz Continental European, is a fund that's quite sensitive on interest rates. So really helped power that through last quarter when government interest rates were dropping quite hard at the November and December, around about 1%. That really helped propel that fund forward. And similarly, we had a couple of good economic indicator outcomes coming up from Europe, so it helped propel that on forward. It's been a fund that has been volatile up and down over the last couple of years, so it's just a really good example of sticking with convictions, understanding what's happening, and not staying rational when perhaps it's not performing fantastic, and understanding why you hold it and carry that throughout that narrative. Make sure that you hold it over the economic cycle, so to speak. With the Fidelity S&P 500 Index Hedge Fund, that's benefited from pound strengthening versus the dollar. So that's helped propel that forward, which would be good. That's given us extra outperformance versus peers, which is obviously always fantastic. And at third place there, you see the FTSE 250, which again, like the Allianz Continental, is more sensitive to interest rate changes than, say, the FTSE 100. On the worst performing there, we see Hypnosis Songs Fund down 10%. Had quite a lot of news going on with that trust last month. I did send out a few communications, I think, whether that be internal or hopefully that made their way out external, which was, I think, actually, even though it was down 10% in price terms for the quarter, I saw quite a few reasons for optimism in the more medium term with that trust, with a raft of positive governance reform steps and strengthening position of the trust's board with the investment manager, really helping to renegotiate fees, for example, with the investment manager, but also help understand with the net asset value within the trust and add a little bit more faith to shareholders. So it's actually something that I can see there being positive news for at some point this year. China was unfortunately, if you talk to anyone within the industry, was a big disappointment for last year. Coming out of 2022, there was the belief of, right, China's coming back online. They're coming out from COVID. If you remember 2022, China was still pretty much in lockdown. It was quite extraordinary, really, compared to the rest of the world. So we were expecting a big bounce this year, which in the economy never came to fruition. There are reasons for that. They're lacking a little bit of credit stimulus, and quite importantly, the consumer is also lacking a little bit of confidence, which is really quite surprising when you consider that the Chinese middle class is sitting on an enormous amount of cash. So that's something that the Chinese economy will be pivoting to over the forthcoming years, is to they're moving a little bit more away from being the manufacturing economy, which got from growth, obviously, as it has done over the last 30 years, into a bit more of a services-orientated economy. And so that's one of the things that we're targeting, is more kind of the consumer exposure that should benefit from that over the coming years. But as mentioned previously, China is now an exceptional piece of value. It now just the earnings yield now is well over 10%. So that's before you even get into more technical factors and valuation potential movements. So there should be very reasonable return for that over the medium term as well. And just want to quickly mention about how active we've been over the last quarter. Obviously, it's what you pay Kate Barcher for, to make these active decisions. And you see there, if I quickly pop to the next slide. So that was 32 trades that we did last month. As I said, it quite seesawed around last quarter, but we managed to stay on the ball with those moves. So just a couple to look at here in terms of batches. We see in November there was a large tranche of trades that went through, which were very much about that going from a more defensive positioning to being more aggressive and picking up the performance that happened, as you see on the right hand side of these graphs. So really helped capitalize on those movements. But yeah, it turned out to be our most active quarter on record with 32 trades there. The 2023 has actually been our most active year, even with 100 trades. Seems almost like it was staged. It's such a round number. But yeah, going from 2022 62 trades to last year with 100 trades, just been very, very active and capitalizing all the movements.
I think on some of those as well, we've sort of set much shorter term horizons on those. So some months we might not even feel a need to trade something, but we just felt with when things, especially on the interest rate front, were sort of at that tipping point, and again we've had that period, October, November, December of no, October, absolutely convinced it's long, higher for longer, and and then a sudden flip, and then there's sort of been 3-4 reversions on that. So we've I think, on the bond side of the portfolio, it's still probably been our better perform, since all the way back to 2019. Which from a multi-asset perspective, it's obviously, it's very easy to pick up the FT or something in the morning and just see all the equity headlines. But we've probably been more active in that bond space. Sam and the team have added models this year tracking spreads between high yield bonds, corporate bonds, government bonds, and very much deriving a risk return basis. What extra benefit are you getting from holding a deemed high risk corporate instrument over a government? And I think this will be a theme to play out over the next 2 years. But I think then it's like Sam's talking about putting on risk, and buying government bonds, putting on risk has been kind of like, a theme of 22, theme of 23, theme of 24. That's not a historical sort of normal pattern, but with getting rates right, as in, are we going to see future expectations hit, or, are expectations, going to drop? We feel we've positioned well Q4 on those expectations, rather than actually, waiting till a central bank announcement, because obviously, in financial markets, it's trying to predict those expectations before, waiting for a, exact thing like an interest rate change. And I think the UK mortgage market is an indication of that at the minute, where, we're obviously still high on interest rates, but sort of sub 4% on longer term mortgages and stuff. So it's having those group discussions and getting those right. I think we've done well on the bond side. We will keep discussing and debating and asking for patience on some of our equity sides. We've talked about those enough the last year and a half. China being one that, yes, everyone still has it on their picks, but we have to exert confidence. But again, China and those markets do become very much a herd mentality trade, where when it suddenly becomes a hot trade, it's it's not 5-6% move, it's the 30-40% move. And again, we're just trying to retain that discipline on capturing that. And as much as we thought that was 23, we are here in 24, sort of looking to make sure we're still in that trade when that sort of that movement does come.
Yeah, I think that's a very good point, actually, in terms of being aggressive, putting risk on that. Actually, but as November, December was such a positive couple of months, that just got a pointer here. Just see that at the very tail end of last year, took sold in the lower portfolios quite a lot, up to 6% of our US Treasury positions, capitalizing on those gains and putting it into the money markets. And that's proved to be exactly the right call this month. Everyone was getting a bit too optimistic after this. It seems to be euphoria, just keep them running away from it. It's like, hang on, let's take a second back here. Let's be a bit more rational. And that's exactly what we've seen this month. There's been a bit of a sell-off in the Treasury market, and with our short-term money market position, we've helped capitalize on that. So that's worked out quite well. Just going to clear that and move
on. Great. So just moving on to some important reporting and portfolio elements that we've sort of been updating on. We've migrated to a flat charging policy for the CBAM portfolios, which we think is an important thing for the next sort of year, 2 years, 3 years. And then in doing that, we've sort of referenced these V1s, V2s, and in meetings people sort of pick up what is the difference between them. And they were very much a legacy thing when we first took the decision to move into Cape Berkshire, to sort of be reflective of probably more people's investment platforms, and the positives and negatives of those, as opposed to particularly wanting to run two different ranges of portfolios. So we sort of had debated all 23. How do we get that to run in just one class that we're happy with, and we're not having to compromise sometimes on holdings in one portfolio over another when from an execution perspective. And I mean, not a big position in the portfolio, but something like clean energy, scratching our head with sort of 15-20% differences, which was not the objective of why we were running the V1 and V2. It was, as I say, the main driver being an execution thing. So we prepped well for that. Busy Christmas for us in getting those right behind the scenes. But yes, essentially the 1 and the 2 are now merged. So if you see anything on your accounts activity wise and stuff, that will be the driving force behind it. So everyone now is in a P class, which we just call P. We thought about planet names, everything else, but in the end simplified it to a P. Any other questions on that? But essentially no change in terms of strategy. Still got access to the universe that we feel comfortable with. I think there have been some thoughts that the V2 was running more conservatively, or necessarily trying to do something different to V1, which was never actually the plan between the two. So this hopefully simplifies that. And want to stress these are multi-asset portfolios that will always primarily be invested in fairly not boring, but because passive funds is a very important part of what we do. One of our CBAM objectives was running these portfolios where we could as cheaply for a client as possible, without compromising where there might be an active activity. So with the prices that you get on the portfolios, significantly sub 50 basis points, and probably actually headed down, that's been a driving factor. So I think outside of funds, these P portfolios probably hold 1 to 3 positions now that would be an ETF or an investment trust, which we're absolutely comfortable with from a platform execution perspective. It's kind of more a pounds and pence exercise in how we can run those for clients across the advisory platforms. So that's all done now. Wanted to bring it up just to re-clarify that more from a reporting perspective. When you see this, you've had the benefit of the webinar and client meetings already for many of you to sort of just be totally comfortable that we think this is the optimal client product to move forward with. Happy to take any further questions on that at the end or outside of this. In addition, we have also put into place an additional set of strategies. So these are sort of brand new strategies, which we've called R. As I say, we just sort of thought we'd have P and R. Nothing's better than one in the middle of the alphabet, or like an A or B or things. So we kept it fairly simple in the naming. So these are things to discuss with advisors. You would have received my note the other day that some smaller value portfolios, and again, I'm sort of talking more of my advisory hat on here than my Kate Berkshire hat on, but for clients that utilize onshore or offshore bonds, for example, where there are fund selection things, they are they've been moved into these R portfolios. But otherwise they're just going to be an alternate tool out there. Client feedback is always great. These are a simplified version of the P. There's absolutely no guarantee which is going to perform better. They're all invested in funds that have their own journeys. They just have a slightly different mandate, and that mandate again is really to make these as user friendly for all clients that we have in the business. We still see the massive operational wins and costing wins from taking that step to have the discretionary fund management business. We want to give confidence that any portfolio that wants fund exposure, there is the right option available. So the changes on R is that they are strictly open-ended investments, so funds. So they will have no ETFs or investment trusts in. Passive where possible. So they do run a few basis points cheaper than the Ps. In India, sort of high yield bonds will always be areas where there's in our opinion, better value outside of a passive. But as you can see from your holdings with us over many years, we've FTSE 250, S&P 500. We will 9 times out of 10 be running the 6, 7, 8 basis point fund for you to keep costs down. Other things that obviously have been a debating point over the last 3 to 4 years. So again, this portfolio gives a different strategy. So whereas we've used hedged funds in the US for initial benefit, paying in 22, better results in 23, this simplifies it. This will only hold funds, again, passive if possible, that do not give the fund manager the ability to do that within his underlying fund, and tighter tracking to benchmark. We've been very happy with how our benchmarks operated for 5+ years now. There's massive value in all the portfolios from the data and intelligence we get from that. So our portfolio just brings an even closer replication of that with just very tight 2% differences. So for example, where we've carried a legacy China position well in excess of that in our existing portfolios and in the Ps, that has been simplified and only has a 2% range there. And then they will probably have less active decisions. Sam, what he's been talking about treasuries there and stuff, that's not really going to be applicable for these. But they will have monthly rather than quarterly rebalancing. So again, it's aim to bring back to a closer target allocation on a monthly basis, and will be tied to benchmark. They will be tied to benchmark. That's what they're designed to do. So and a reduced annual management charge on those from a Cape Berkshire perspective. So that's our modernisation. We're excited to roll those out. Reporting won't really be affected if you've been in one of the others and you move. We obviously report that at a client level with your advisor. So any questions? Happy to take them at the end.
There was here just a side-by-side comparison of the two equivalent portfolios of the threes, so to speak. Unfortunately, I think the text is so small on that; it's quite difficult to talk about.
I certainly can't read that.
With my slightly more youthful eyes, I can. but it basically just illustrating there that holding passives very much within the R class, very much helps keep the costs down. But within the Ps, we're able to make the most of short-term decisions. If we see an opportunity to utilize it, whether that be through a larger allocation away from benchmark or it being a bit more ad hoc rather than on the month, with our portfolio moves. Okay, so looking forward to this month, actually. I was about to say to the next quarter, but we're already there. So inflation, obviously that's been a bit of a hot topic this week with UK inflation on the month coming in quite a bit over estimate. What I would say with that, though, is that if you had taken the previous 6 months together and taken an annualized rate of that, it was close to zero. So inflation is very much kind of at the moment foregoing any crisis through like the Gulf of Aden, etc. Is a little bit of a mission accomplished. It's just a case of when do these rates start to come down rather than are they going to. There will be rate cuts this year foregoing some kind of crisis. I think that's very much the case. Government bond over optimism, as I talked about earlier with November, December, government debt yields were coming right down, which is fantastic from the value, if you already hold it perspective. We just saw that people have been getting far too caught up in the euphoria of that and took the opportunity to be a bit more defensive and it's exactly what's happened so far this month is that those yields have started to rise, i.e. the capital value of the existing bonds coming down. So that's helped protect us a little bit. China valuations, as I mentioned, we're now at a point with China where it is incredibly attractive. And over the longer term is expected by the vast majority of analysts to be probably the best performing country over, for example, 10 years. But it's about trying to make sure that we capture that correctly in the short term. There's things that they can do, the Chinese government. They know what they are, if I'm honest. The Chinese government are an intelligent lot. They know the policy changes that would help things along. They've just got a slightly different list of priorities compared to, say, Western economies. So it's about when do they pull those triggers to help push them along. But there's certainly calls for it occurring, so we take that being positive.
I think just on that point, from a fund perspective, I think one of the good exercises that we've done is gone through all the holdings. Certainly in the P class, and we certainly have a much clearer picture of with these inflationary factors. We have things that we have like a 1 to 3 month range on. We have things that we think will need a year to see how the inflationary factors play out to them, and then we have sort of buckets outside of that we don't think are particularly inflation sensitive, that we have more price driven numbers on. So yeah, inflation is going to keep being a talking point, but I think it sort of affects 3 different buckets of the portfolios in different ways. And it's certainly in the inflation sensitive, just to stress, is definitely the treasury positions, which again is in the 1 to 3 month bucket, and that's because Sam, we were very overweight treasuries. We've now flipped, not necessarily to be an underweight treasuries, but Sam went very short duration, but I expect that to flip back again. So kind of in that bond space, we're going to have to continue to be more nimble. Whereas, the Allianz Europe had a great quarter, but it's inflation sensitive, but we think there's some value elements to that as well, which will kind of be a sort of more mid-summer decision whether to keep that or flip back to index.
Yeah. And we're very early on in this quarter's earnings season, but at the moment, things are coming in around estimate or slightly above. There is expectation perhaps in quarter 2, quarter 3 that there might be some misses, particularly in the US. So that could be interesting. And to be fair, one thing that I think has very much been true, not just of ourselves, but also within our benchmark portfolios, over the last year, is the allocation to US equities come down quite a bit, actually, hasn't it, over the last year? So that's possibly something that we might reduce a little bit more over the next few months, just on, as Mark was saying, valuation kind of elements. But we'll make sure that there are areas of the market that will be growing. So it's about making sure that we select the right areas. Then slightly more technical points to finish on of this list is Purchasing Manager Index data. So that's kind of like data that comes directly from company managers about their optimism within broad economies. So it's done kind of like on aggregate. We see those in a lot of areas have now bottomed out and are now started to increase. So would be expecting more we're probably towards the end now of European growth being down, so to speak. Probably expecting more of an upturn that over the next 12 months, which we look forward to very much. And then just quickly mentioning the meetings that we got just this month alone, I can see there quite a breadth, quite a few conferences in there. So I'm certainly going to be busy over the next couple of weeks with lots of note writing and things to consider. But yeah, just throw this slide in just to show you guys that we are very much active on these portfolios. And although we might not be making trade decisions, there's an awful lot of research and conversations going on with, say, economists or fund managers in the background. And then just looking at how we currently are versus the benchmark, see there, as mentioned, so sorry, this is a terrible graphic. Unfortunately, there's so much information on one slide that it makes it difficult to point things out. So, oh no, sorry, I've done the wrong one. So there, as mentioned, the government interests of US securities, been underweight on the bit, just helped on the defensiveness of the portfolio over this month, which has been nice. But also we're far more neutral on North American equities. We were certainly positive on those 2 years ago, so a little bit different now, and how overweight we are on cash and money market at the moment. In portfolio 2, we're actually over 5% overweight on cash, which has been good and what's been proved to be a month to be a bit more defensive. Things that we've added to that a bit more aggressive on has been on absolute return, which has been an addition of a structured products fund over the last quarter, which is working exactly as we would hope for those people who aren't used to structured products. So they're kind of a bond where the interest given is linked to contracted terms of say an underlying index performance. So, for example, if the S&P is more than 65% of its original level at the expiry of a bond, it will say return 30%. So these can be very good instruments to have in an awful lot of market conditions. And that's been performing exactly as we would have expected over the last few months. So it captured the positive performance from the last 2 months, but then going into this month, it's been ticking along nice and gently, just as it performs more like a bond. So that's been really worthwhile there. So that comes to the end of our pre-planned slides this month, but we're more than happy and looking forward to some questions, etc. Do have some extra annexed slides if anyone has questions.
Thanks, guys. Yeah, we do have a couple of questions that have come through. So we've got one from Glenn Davies. What is your strategy regarding China going forwards?
Strategy for China sort of depends what perhaps if those questions came in mid-presentation, but I mean I'll go back over points there. So strategy for China is certainly not to add any more to the portfolios. It's probably been a good 9 months, perhaps even longer, since our last active edition of China. But yeah, as I sort of touched on in there, it is a market that, when it gets structurally supported, when something goes right geopolitically, it's a market that isn't going to sort of just have a sort of 6-7% recovery from the values it is so deeply discounted that our strategy is certainly a gradual overweight exit in 2024. We don't think we bring that position to an underweight position, but as I say, we haven't had that. It was only a year ago where there was 30% plus movements in that. So yeah, it is one position that we continue to exert patience on, simply because of the valuation levels we feel that it still sits at.
I think one of the things that perhaps we're looking at there is, as I was talking about, return on equity. So at the moment, China's the valuations work out that you're getting around about 12.5% to 13% return on equity. at the moment, which is well outside of its standard deviations of what is normal. If that was to come down to around about 8%, which would be a valuation increase, so positive for portfolios, I think at that point might be the time that we would be definitely changing the portfolios.
Yeah, which would probably be a 15 to 20% move.
Yeah.
From where we are. Target growth rates for P&R. Yeah, that's probably still more an advisory question, which I'm happy to take, because absolutely nothing has changed. Nothing has changed on that. Certainly we would probably have to go back, 5 to 10 years to sort of derive, proof of the 5 portfolios delivering what they wanted. Certainly looking at a 3-year view, they'd be very jumbled in terms of target growth rates. But yeah, I think 2023, where we ended, sort of, probably gives a decent steer towards that. So, I think probably it's one slide we will add in post-meeting that we reported on the quarter. I don't think we actually reported on the year, where I think it was like 5.2 to 9.1 was the ranges. So I think, our portfolio one is always going to be sort of a 4 to 6% target over sort of a 5-year rolling period, and our portfolio 5, would be more like a 9 to 11, which certainly that hasn't been the case over a 3-year, but I think having looked at these sort of 5-year rolling averages over many years, it was only probably 2020 when those were sort of on the rolling 10-year averages and stuff. So yeah, hopefully that answers that question. How do you think the UK US elections will play into equity markets?
Oh, a lot. With regards to UK elections, probably not a huge amount. The Labour lead in the polls is so large that I think a Labour majority is pretty much nailed on the door, and so the chances of surprise going on there, and it's largely surprise which moves markets, is quite small. In the US is a little bit different. So as you may have seen, Donald Trump won the Republican Iowa primary this week. Next day, there was around about 3.25% decline on China, MSCI China, which in some ways is a little bit surprising, considering I don't think anyone would have been surprised if Donald Trump won that. And also, it's also a little bit surprising because as much as Donald Trump obviously talks very loudly, Joe Biden has actually been far more stringent on China than even Donald Trump was. So from a Chinese perspective, you'd probably find that there's much difference whether you get a Republican or Democrat win at the end of the day anyway. It's just two of the things that go to mind. But what's mad is it isn't just UK and US elections this year. I think it's something like over 90% of the world's democratic population this year goes to the polls. It's an extraordinary year. So there's a lot of areas to keep an eye on. But one, I think I might have included it actually, Don. No, I was wondering whether to include it or not, but I didn't. It's a comparison between Republican win years and Democratic win years. As much as there's a lot of conversation about a Republican win being good for markets, if you look at it over more like a 2-year view post-election, the returns on average are pretty much the same. So it's there's all kinds of things that go into the equation on the US, to be fair, because you've got like budget deficits and all those elements, which I think over the next 5 years can be quite interesting. Sorry, it's one of those things that I could talk forever on, but I'm trying to keep it fairly short.
Just great. Okay. Yeah, we've just got another question coming in, I think. So in the meantime, I'll just use a couple of seconds to let everyone know that we're going to put a survey up after Sam and Mark have finished presenting. So if you do have 30 seconds of time just to leave some feedback for us, obviously that would be greatly appreciated. I'll leave it up for the next 5 minutes or so. And we also have next month's webinar coming up where we have Claire with us for the tax year end webinar, which is quite a good one. It's quite a popular one. So obviously there's a button up there you can just book your seats on, or you should be seeing some invitations coming out end of tomorrow. So obviously keep an eye out for those coming in as well. We do have a final question from David Good. As I pay more for the investment in P, then what would you consider to be a successful execution of this revised CBAM strategy?
It's a good question. As I say, there's nothing that definitely defines the P beat in the R. It's really just a reflection that there's more thought and execution going into that. You're in theory paying 15 basis points more, so as I say, on a sort of yearly and ongoing basis, I totally understand what you're saying there, but equally that is again why we're trying to also put two different ideologies out there, which I think is right for the diversity of the client bank and stuff. So yeah, number one, there's got to be 15 basis points outperformance in justifying that. So I'd probably say to expect 0.5% would be, I think, a realistic target. I wouldn't go too much higher than that, because as much as we're saying the P's obviously remain exactly what we've been doing and how we've been trying to execute things. We do have benchmarks, exactly the same benchmark to still stick to. We just wanted to put an alternative solution out there into the market for clients that might want to hear less talking of overweight positions and stuff, and that suits their style, their advised interpretation of what they need more. But hopefully that answers the question from a numeric perspective. I'd say 15 points has to be the minimum, and 50 basis points better over an extended period per year.
I think that's a good point, actually, to say that you would expect over, say, a rolling 3-year period. There will always be obviously short periods of underperformance, but it's more over that 3-year.
Yeah,
I think that's a good point.
Okay, as mentioned, we've just had another question come in, actually. If you covered this in the first 9 minutes, apologies, please don't repeat for me being late. What is your outlook in terms of next steps for hypnosis and realizing an uplift in value?
We didn't touch on it. Conscious to not talk about hypnosis in every presentation that we put out there. Sam touched on some elements of definitely better corporate governance coming in, and as much as that sort of 10% number on the quarter, to be honest, it's been sort of not surprisingly tight in range, but it really has sort of stuck between 70 and 72. We're still in regular contact. I think the signs are for it to be run significantly better, and if it doesn't, we're all in the same boat, I think, as the sort of new directors and activist investors, that it can't go on forever. So that's kind of still where we are at the minute. Me and Sam, discuss it in terms of gradual exits. I think certainly we've talked about pounds before, but I think our exit out of it, would probably be more in the 80 to 85p range as a starting point right now. Sam crunches much more detailed numbers on challenges to the net asset values and stuff, and as much as we have viewed that as being sub £1 for a significant period, Sam probably more of the view that it's tighter to a pound now. So yeah, as a result, I don't think we're going to be massively greedy on that going forward. So I think in terms of an unwind, or certainly a reduction in holding, probably around 80p is going to be the level where that becomes relevant.
Yeah, I think one of the weird things, well, not weird, but the performance last quarter, don't get me wrong, there was reasons for it to be down. But I think one of the reasons for that and the performance last quarter as well was going back to that governance kind of factor, was an increased transparency from the new board, and more of a challenging of whether that be the independent valuer, or it being of, as I mentioned, the investment manager, and so therefore just being far more transparent and challenging, and so you ended up with more public news in that regard that perhaps would have been hidden away. So, for example, one of the reasons that was negative was that the trust delayed its accounts by 2 days, which obviously was seen by the market not to be a positive thing. But the reasons for that were very much the board was challenging, as those two parties previously mentioned, to ensure that the accounts were accurate, were portraying an accurate portrayal of a business to investors. It's been slightly refreshing having that kind of view, but look forward to the board members being pushing value from the investment far more in the future. As you mentioned, there's a lot more of activist involvement now within that position, and some of the board members that joined in, one of whom was the chairman from a very similar fund that sold out, and so basically there was an exit there in last quarter. So a board with experience and with an activist mindset has been very welcome. But I think in the short term, as I said, that resulted in bad news coming through as the new board was saying, look what the previous guys did from a transparency perspective.
And yeah, probably still what isn't priced in at all is, any drop in US interest rates. There hasn't been any reflection pricing wise of an expectation of drops, but perhaps there needs to be a physical drop for there to be some repricing of that, because as much as on reflection there was obviously things going on at board level that could have been drastically better over 2 years. The driving factor from 130 where we never held it down to sort of 70-80p. It was the pain that the financing side had been feeling on rising rates. Well, we haven't had any benefit in pricing from an expectation of drop in rates. So, I think again, a percent off US rates and complete validation of normality back where they may refinance their debt at 3%, not 6%. That's a massive value pricing in something that was such a value pricing on the way down. And I think people are still more pricing it based off news headlines and directors' activities and stuff. Which if we can get through that, then we get one repricing and we'll absolutely review that. I'd love to be back to 3%, not 6%. The underlying P&L behind the things they hold has still been good. The revenues and stuff have still technically been growing, but it's all kind of been forgotten about in the pricing of it. So hopefully that answers that question.
Lovely. All right, well, thank you, everyone. So, like I said, I'm going to leave this just up for another couple of minutes, and we hope to see you at Claire's webinar next month. Thank you.
Thanks all.
Thanks.